Good afternoon, everyone, and welcome to the ReachX webcast. Today, we're going to talk about the oil market. We're very happy to host Gaurav Sharma. He is the ReachX editor. He has been providing research and analysis for multiple financial clients. He writes for Forbes, RigZone, Energy Post, and he's also a regular commentator at energy industry forums, including the OPEC conference streams and several broadcasts, including CNBC and BBC. Today, the oil price reached its year high, so it's an opportune moment to talk about what we expect for the next few months. I'm going to hand it over to you, Gaurav. Welcome.
Thank you for having me on, Rafael. I think it's a very opportune time to meet as to where is the direction, what's the direction of the oil market, where are we heading to? And I think we're at this critical juncture where we've had a very bullish first quarter for the year. And I think sort of 3 weeks rather, into the second quarter, the trend line seems to be upward, whatever benchmark you use, whether you're using Brent crude, West Texas, or in fact, OPEC's rejigged basket this year following Qatar's departure. Now, I think let me just sort of jump straight on to the slides. And I think before we go forward, I think it's worth having a quick look at how 2018 panned out. And I think this slide sums it all for you. The oil market was ticking along quite nicely in a very predictable $60 to $80 range. There was some volatility, but that oscillation was in a very predictable range. Then lo and behold, what started happening towards the third quarter of last year was that there was this considered opinion that the geopolitics was coming into play, that OPEC had somewhat done its job, that the inventories were just about touching, the OECD inventories were touching their 5-year averages. And therefore, chatter started that perhaps oil is somewhere on the upward curve, especially after the Trump administration took unilateral action to sanction Tehran. Now, what we saw was that a number of speculators then piled onto what was a mini rally in the third quarter and extended it into a maxi rally, i.e., that a number of these guys came into a number of speculators who predictably do not have much of a footprint in the physical market, came into play and decided to extend the fans of geopolitical tension, of what OPEC was saying, of Trump tweets, and all the rest of it. Essentially, what that happened was that it took Brent, especially, up above and upwards from the $80 threshold. And I think that was a bit premature, because there was still plenty of oil out there in the market in terms of the supply-demand dynamic, which we will touch on later on in the webcast. But I think what then happened was towards the third quarter, because the rally overran, it also got, in my considered opinion, also got a bit oversold towards the fourth quarter. And we had a massive correction. We had, as this chart indicates, that by the time OPEC met from its summer meet, we had fallen from $80 to somewhere sub 60 and kept on falling, especially the West Texas, come the end of the year to almost $45 before a recovery began. So a lot of people say, is there something as a market that is oversold? And I think there is. Basically, that overselling kind of found its floor towards round by the festive period, towards the end of the fourth quarter. And Q4 ended up on a very sour note. Now, that set us up very nicely for the first quarter of 2019, where a lot of people, rightly so in my opinion, thought that a bit of realism is going to creep back into the market. Now, given what we had in 2019, we can examine both the bullish and the bearish factors. But let's start with the bullish factors first. Now, what we have here, if I go to the next slide, what we have here is that the OECD inventories are lurking at near 5-year average. You've had several OPEC members, especially the Saudi oil minister, Mr. Khalid Al-Falih, the kingpin, who's the kingpin in many people's eyes, consistently opine that if the 5-year average, the OECD 5-year inventory average, is where they want it to be, which would be somewhere in the region of about, say about 2.7 billion barrels of oil, then they would consider their mission accomplished. It's somewhere around 2.88 billion barrels. So that's as close as it gets, just a little bit above where OPEC wants it. Now, Venezuela, it's a complete basket case of persistent declines. This is a country which was a leading OPEC producer, one of the OPEC hawks. But right now, given its own situation, its own political complications, and its consistent state of underinvestment, Venezuelan production has fallen below 1 million barrels per day. And I think at last count, it is somewhere in the region of 740,000 barrels per day, which is so bad that for the first time in many decades, in fact, Colombia has actually overtaken Venezuela in terms of exports to the United States. Now, that again supports the price. Alongside that, you have the persistent nagging problems that they've always dogged Nigerian production. And add to that mix is what is ongoing in the should I call it the second phase of the Libyan civil war, with a general who's a dual Libyan US citizen, has somewhat with the tacit support of Saudi Arabia, Egypt, and some say even the Trump White House, appears to be marching on a UN approved government in Tripoli. And General Haftar, or should I say Field Marshal Haftar, already has captured some significant oil fields. So that again is price supportive. Now we have the news, we recently had the news, and the US government has confirmed that it will not extend the waivers that it granted to many of the principal importers of Iranian crude. And I think those waivers are set to expire on the 2nd of May, not long to go now. And China, India, and South Korea would be the primary people to sort of feel the heat. Now, a lot has been said about how far and how further does OPEC and this non-OPEC, this newfound love between the Kremlin and Riyadh, how far is that going to extend? So far, there have been some tensions, there have been some rumblings, but the OPEC, non-OPEC discipline, or should I say the Saudi-Russian cooperation, has held firm. It's basically blown off the arguments of some of the skeptics so far. We don't know how far it'll hold, and we'll have a discussion about that later on in the conversation. Now, then again, we have the whole specter of persistently increasing US production. And according to the IEA, it's tipped to touch 15 million barrels per day in a matter of around about 4 fiscal years. But right now, what is happening is that the pipeline capacity taking the Permian Shale, which is the sort of a key region alongside the Dakotas and of course the Eagle Ford, is the bottleneck, the capacity bottleneck that the pipelines are facing. So that there's some impediments in that crude getting to the market. So these are the key bullish factors. Let's now sum up the bearish factors. Now, these are the downside risks to oil price. People keep asking me at industry forums, at broadcasters, where are we heading from there? Now, let's look at the consumption patterns first. Global demand is, depending on whom you rely on, OPEC, IEA, whichever course we take, it's somewhere in the region of 1.4 million barrels per day in terms of demand growth. OPEC is the more optimistic of the two. IEA is about 1.3. Now, that keeps total demand just shy of about around 100 million barrels per day. It's around 99 point some decimal figure there. But this, based on my modeling, and we'll talk about those key production centers, this can be adequately met by current supplies, so as to exclude some really big geopolitical infractions. And by that, I don't mean what's going on at the moment, but something along the lines of, say, a potential terrorist attack on the Saudi east-west pipelines. It'll take a geopolitical infraction of that magnitude. Now, people keep talking about the loss of Iranian barrels, and I'll go into some detail later. But right now, if Iran feels a full Trump squeeze, it is likely to be compensated by upticks from elsewhere in volume terms. So Saudi Arabia, Russia, and the United States, between them, 3 producers alone are pumping somewhere in the region of 30 million barrels per day between them, and that is a third, just shy a third of the entire demand of crude oil in the world. And what's happening is that as Malaysian and Indonesian production has to decline, some of these lighter, sweeter American barrels are just heading eastwards. Now, macroeconomics matters. We don't know the current occupant of the White House is so unpredictable. He does diplomacy by Twitter. There is hope that the trade war between US and China would be resolved. But equally, there are also pessimists out there saying Trump being Trump, who knows what might happen. And that is a serious question mark over oil demand for 2019. We, of course, have Brexit and the German slowdown and a whole host of other factors complicating things in Europe. Now, let's say China lowers US crude demands and continues to defy the Americans and kind of get back, start taking Iranian imports. Those American barrels, given the nature of shale exploration, they have to go somewhere. And most of it is light crude instead of the heavy sour variety. And much of it could then have a knock-on effect on Asian markets, where there could be a surplus of American light crude and other light crudes as Angola and Nigeria try to divert the cargo that was some 5, 6, 7, 8 years ago destined for American shores, but now has to find a market elsewhere. And finally, OPEC, non-OPEC decorum. The decorum is only as good as the week we talk about it. And it's good now. They're meeting again on the 25th of June. That decorum could pretty much go. Now, what are the demand centers? Now, this is a chart which is very, very telling. And I bring it up at wherever I am, whichever industry forum I have. I've also spoken about it variously and written about it on ReachX as well, is that in September 2018, and you cannot overstate or understate, you take it at what it is, that the tectonic plates of the market were shifted by a simple announcement and an audit by the EIA, which confirmed that the United States is the world's largest producer. And is producing right now somewhere just short of 11 million barrels per day. According to the National Energy Agency, and I interviewed their executive director, Dr. Fatih Birol, he said that the second wave of shale is coming. And that second wave, which would probably be underpinned by even better technology than what got the United States this far, could potentially bump up American production to somewhere in the region of 15 million barrels per day in a short matter of 4 fiscal years. So we're looking at 2022, 23. And at the same time, the Russians and the Saudis are cooperating in cutting. So over the next 5 to 7 years, given the nature of shale production, this oil has nowhere else to go but to come onto the market. That is the very nature of shale drilling, that the decline rates will kick in 5 to 7 years, and then a fresh round of spudding has to be done. But right now, copious amounts of American oil, especially light crude oil, is going to come to the market. Let's proceed to the next. And here you go. After the Obama administration lifted the ban on American crude, on crude exports, not only is America, it always was a key player in distillate markets. A lot of American crude is heading overseas in incremental volumes, and the data supports that. And this trend is unlikely to subside in 2019. In fact, if anything else, we'll see more and more of it. And this is audited data from the EIA as to where those barrels are heading, and practically every demand center that you can think of in Asia and Oceania, Europe, North America itself, Central and South America, Middle East and Africa, it's American crude is everywhere. And I think Moody's put up a recent report out saying that the US is going to import less and less of Latin American oil. And that has credit implications for some of the Latin American exporters, because they will again have to look elsewhere. And that kind of supports my theory that there is still plenty of oil in the market. The oil market can take a shock of about 2 million barrels per day being knocked off. Now, let's look at the latest inventory and production numbers, because a lot of the listeners would want to have a perspective on some raw numbers. And these are the raw numbers that can help color people's visions. So OPEC's March crude output, it fell by about 500,000, a little over 500,000. So OPEC is right now, excluding the production of Iraq, which is exempt, is producing somewhere in the region of 30.23 million barrels per day, according to my colleagues at S&P Global Platts. That's the latest survey. Now, where do we stand with Iran? Iran produced around about 2 million, just shy of 2 million barrels per day in March this year. Now, I suspect with the Trump squeeze, especially with the Indians and the Koreans having confirmed that they're looking for alternative sources, not easy, but they are. And a number of Iranian exporters, small importers, I beg your pardon, such as Vietnam, Sri Lanka, etc., also confirming that they're looking elsewhere. I suspect this could be knocked by half. So we expect a decline of about maybe 1 million barrels per day as a result of US action. It's effective, but I suspect not as effective as the Obama sanctions. But of course, let's see where this goes. Tension in Libya, another 1 million barrels per day knocked offline. Venezuela, I think I touched on it earlier. I think got a 750. I think it's around 740, even lower than what the slide says, and that's a 16-year low. Now, how will this all be countered, especially that big hole that Iran might leave? Now, I mentioned these 4 countries: Saudi Arabia, Russia, UAE, and Iraq, specifically because these 4 countries have the kind of crudes that could be a possible match for Asian importers to sort of step into the breach. The only thing is that with the Saudis having burnt their fingers last year, when Trump said he's going to crack down on Iran, but then eventually granted Iranian importers some waivers, the Saudis are a little bit nervy. They'll play along, but they'll wait for the data. But these 4 countries have the potential to step in, and I suspect Russia and Saudi Arabia would play a major role. And I think a lot of people are testing the heavier crudes out, relying on the Russian Urals to see where this goes. As for US, well, it leads the non-OPEC production chart with close to 11 million BPD led by shale output. Now let's have a word about those inventories that I mentioned. OPEC keeps bringing up these OECD inventories, that it's been looking at it, that it was a key factor in its decision to take 1.8 million barrels per day of production out. I mean, 1.3 million was footed by OPEC and 500,000 by 10 non-OPEC members last year, led by Russia. Now, they keep bringing up these OECD inventories, and the latest data suggests they're at 2.88 billion barrels, and that's exactly 19.1 million barrels above the 5-year average that the last call that the Saudi oil minister took from analysts. So it's pretty close. So assuming that Trump puts the squeeze on Iran like he wants to, this does give OPEC some kind, or perhaps the Saudis and the Russian, some kind of leeway to say, well, look, it's mission accomplished. Let's try and up the production. It's all hypothetical, but it is possible. Now let's look at the trend lines for both major benchmarks this far into April. Now these are the Friday closes, and I tend to use the Friday closes because it sort of irons out the weekly volatility. So even if you use the Friday closes of both the major benchmarks, Brent West Texas and the OPEC basket, it's a reversion to norm, to be honest. So that overselling that we saw, that we discussed earlier on in our discussion towards the 4th quarter, went some way towards correcting. And given the geopolitical factors at play right now, the sort of direction of travel appears to be, if you drew trend lines for all 3, would be upwards. So we are where we are, but there's also the whole question of, where would it meet resistance? What's the floor? Has the price found a floor? Yes, it definitely has. But given what we've said in terms of the amount of oil there is out in the market and what can or cannot happen, the geopolitical premium, especially courtesy of the Americans, is nothing like it was, let's say, hypothetically in 2011, 2012. But some of the listeners might recollect that back in those days, if you spoke to any trader in Chicago or in London, they would immediately tell you there is a geopolitical premium or risk premium of at least $10 there. Now, that geopolitical premium that was near permanently there has effectively been neutered by incremental American barrels. So there is a geopolitical uplift there, but it's nowhere near it should be. That said, oil price, the Brent has touched 75, keeps lurking either side of it, but the trend line might well be upwards. There's still plenty on the horizon to suggest that we are stuck in this modest range, and I'll come to that. I'll come to that in a second. Now, the other thing is, what do the producers want? Are the producers particularly happy? Would the producers be particularly happy, especially in this climate, of having an oil price that overshoots 80, and then suddenly there's a clamor for less consumption? I'm not so sure about that, because there have been points in history where OPEC has seen spikes to three figures, and the next graphic will illustrate it, and has literally come down with a thud. And this takes us back to the pre-crisis levels, the pre-Lehman Brothers levels, and there you have it. We had this sort of massive uptick prior to the crisis, and we almost headed to $140 in the predictions that we'll see 200, and we came down with a bang, or a thud, I should say, to about $37. Again, post-crisis, there was a recovery phase where we hit three-figure prices for quite a period of time, up and until, ironically, ISIS's invasion into Iraq. And then again, once people started factoring in incremental non-OPEC barrels, suddenly the decline that began, the slump that began in June 2014, when all the way up to January 2016, where we had sub $30 prices before all the various parties came together to try and support the prices. So I don't know, deep down, I've covered OPEC for a long time. I've covered all summits, all OPEC summits, literally since 2008. I'm just not convinced that OPEC really wants three-figure prices. So who knows what might happen in June? Much of it will depend on what the data tells us on Iranian barrels. But I suspect you will have a move from OPEC saying that they will add a few barrels to the market. And who knows what that might do to the current existing Saudi-Russian harmony. So that might happen too. Now, a lot of people be wondering, where are we going from here? So what can we expect? Okay, so as things stand, based on Argus, S&P Global Platts, and various independent surveys or data aggregators, I would say collectively, based on an annualized basis, Russia, Saudi Arabia, the United Arab Emirates, and Iraq have taken about 1.3 million barrels per day of production out between them. I strongly expect this to come back to the supply pool very shortly, and I think it'll come back gradually. There'll be some sound bites first before it starts getting reflected in the data. But I suspect that once we're at the height of the summer, we'll see that coming, and I think that it'll be borne out more, borne out in the empirical data much more towards the sort of the end of the third quarter. Now, the Chinese, well, I don't know, they might want to spite Trump, but I suspect that out of the big five, I don't think the Iranians are going to get much leeway from Japan, from South Korea, and from India. But China might have Iran where it wants it. Basically, the Chinese might, as a matter of fact, increase Iranian export, quite possibly under the radar, or quite possibly quite openly, to challenge Mr. Trump. Now, Saudis will remain reactive to the US v Iran tussle, quite possibly because within OPEC, Riyadh and Tehran are the old protagonists. There's history there, but I don't think, unlike 2018, they'll wait for some affirmation of US action on crude volumes before they go. Global inventories, again, I think the global inventories, the OECD inventories, might give the doves in OPEC. By that I mean Saudis, the Kuwaitis, the Emiratis, and to a certain extent the Iraqis. The pretext saying, well, look, we've done what we could. It's time to move on. That will also have a domino effect on the 10 non-OPEC players, especially Russia, gives them a carte blanche to sort of go ahead and up their production as well. All right, being an optimist here, China-US trade resolution, I think we could expect that in the second half of the year. Fed policy, well, I think it looks like it's pretty dovish, and I think the European slowdown for various factors, not just the German economy, remains a concern. So that's a bit of the summing up some of the macro factors. Now, of the big five crude importers, and I've been talking about it like a broken record for a good few years now, is that if you take the big five crude importers, i.e. the United States, China, India, which overtook Japan to the third spot, then Japan, and then South Korea, of these big five, Chinese demand would be there or thereabouts. It's not going to be anywhere near the levels of its own commodity-driven boom in 2012. The US will turn less and less to the global markets. So will Japan and South Korea for very different reasons. But India is the only demand of the big five, the only demand center where 2019 would end up it importing considerably more than it did in 2018 or 2017. More US light crude on global markets, it's a certainty. I think the one side effect of the shale revolution has been that the direction of the cargo is eastwards, excuse me, and it's also very lighter. OPEC next meets on, excuse me, on the 25th of June and won't move unless US intentions are visible. Now, what does that mean for the price? That's the key question here. I expect Brent to average towards the upper end of the 70 to 75 per barrel. And I expect the West Texas to average the lower end of the 65 to 70 barrel. And I think the benchmark spread could be around $8 a barrel. And I think the reason for that is that we are kind of stuck in the modest middle. That is because while there is geopolitical infraction, while there are pressures on the sort of volumes that would reach the supply pool, there's also still adequate amount of oil that is going to meet the supply pool. So what do? You've got many rallies going on left, right, and center. And in that context, you can, given the set of variables we have, you can be long over the short term, but over the long term, I think short is the call, because we are oscillating in a certain range that we are finding it very difficult to escape.
Thanks a lot, Gaurav, for sharing your insights. We're now going to move to the Q&A. So for our attendees, if you have any questions and you're logged online, if you can just raise your hand and you can actually type your questions, that would be the best way. I just have a few questions that I want to share with the audience. You spoke a lot about the role of the US and its growing production. Are they now the swing producer in the world, and is OPEC role diminishing as a result?
Look, it's a very simple answer. The incremental American volumes have been driven by the spirit of private enterprise. Even if the Americans wanted to go down that route, that avenue is not available to them. So in a classic sense, a swing producer is one that can at will turn the taps up and down. And that for that reason alone, the world's classic swing producer was, is, and perhaps will always remain Saudi Arabia. Now, what I describe the Americans, I've been asked this question before, how I describe the Americans is as a buffer producer. That here is this producer who has, for a finite period of time that extends well into the medium term, not just the short term, for the next 5 to 7 years, has shifted the tectonic plates of on the supply side, primarily with light crude. And it's been driven by a form of unconventional exploration where it's a very quick uptake and a very quick decline rate, and then you spud another oil, and so it goes. Whether we're talking the DJ Basin, the Permian, the Eagle Ford, that's the very nature of shale exploration. So for the next 5 to 7 years, the Americans will be the buffer producers. but perhaps not the swing producers.
Understood. And another question comes to mind when we talk about the recent sanctions that President Trump has decided to reinstate against Iran. Do we think that they're going to be effective? Because we know in the past those sanctions has always been circumvented in a way or another. And do you think it will have an impact really on the oil market?
It's difficult to say at this moment because we await the data. But one thing I can say quite safely: they will perhaps not be as effective as the Obama sanctions. That's because when President Obama, his predecessor, went down this route, he had holistic cooperation. He also, if not wholly, but partially got the Chinese on board. Right now, Mr. Trump is fighting trade wars on various fronts. He's not particularly getting along with the Chinese, although he'd like to say so. So there is really no incentive for China to play ball. The Europeans are also finding ways, mitigation mechanism, perhaps not as effective, especially because Mr. Trump would then come down hard on the European financial services sector if they serve as intermediaries, and on the insurers. You got to insure the cargo. What really killed Iranian exports in the Obama era sanctions was the fact that the Iranians could not insure their cargo. Now, there could be some way they could get around this, especially when it comes to getting the crude China. They'll be effective, but not as effective as Mr. Obama's sanctions. I think by conservative estimates, 400,000 barrels per day of Iranian export could be knocked out. By a very optimistic estimate, which is what I used as a base case scenario here, about a million. But that still be nowhere near what President Obama achieved.
Just another question while we're talking about politics. Obviously, the U.S. elections are 2 years away now. And we're wondering how a change potentially in the landscape could have an impact on the policy of U.S. with the energy and environment, especially. Imagine we have a Joe Biden presidency, for example. Would that radically change the picture?
I'm not a political expert, but what I would say here is that how Mr. Trump went about his business in the last election was that he played it, in my opinion, like a game of chess. He played it very strategically, went out the states where his core base, or rather what he thought was his core base, could take things to the next level, and ultimately got the keys to the White House. Now, what about Mr. Biden? Now, people say of the huge field of Democrats, Mr. Biden perhaps has the best chance of unseating Donald Trump. I tend to concur with that. But in order to appeal to that, depends on what Biden says on the campaign trail and what Biden, should he get into office too. Now, in order to get into office, I think Biden will need to appeal to a millennial base. He would need to say some of the sort of taxation heavy sound bites. So I think he might not be the messiah that the oil industry claims, but then he might not be the grim reaper either.
Thanks for that. We have a question from the audience regarding U.S. Oil production. Just wondering if 15 million barrels a day is a realistic number within 4 years.
I think it is pretty realistic, except for the fact that the economics is pretty poor as far as the shale business goes, and we keep hearing that from the ratings agencies, from the equity analysts, from the private equity guys who are trying to buy some of these distressed assets in shale. But you understand the nature of this exploration. A lot of this oil has really nowhere to go but out. So there will be distress in the shale, in the U.S. shale industry. But that 15 million barrels per day output is pretty realistic in my opinion, because right now where it is that you visit these basins, and I've had site visits in the DJ Basin. I've had site visits in both in Permian and Eagle Ford. You visit the same sites over a period of time, and you see that they're making do with fewer personnel, fewer logistics, but are producing more. So some of these guys can actually, I'm not saying that they want to, but some of these guys can actually be profitable at $35 a barrel. So that oil is coming. Now, what that does to demand, I think what they're also doing is they're cognizant of the fact that the demand dynamic might materially alter. But the IEA seems to believe in this 15 MBPD argument. even if every second car, and we're nowhere near that, even if every second car is electric, even then it still expects oil demand to grow. So there is a serviceable demand. And these guys think that if it's that serviceable demand is we're talking petrochemicals and we're talking aviation, then a lot of these American guys think that they will have a ready and willing clientele, and they're incrementally looking eastwards. So 15 Mbpd is indeed realistic in my opinion.
Another question from the audience. Well, you were talking about efficiencies in energy consumption. Obviously, transportation is widely affected, but construction is also being affected, right? Buildings are more energy efficient. If the US were to join again the Paris Agreement and do something about it, won't you see an acceleration in those efficiencies? And wouldn't that affect demand a bit more radically in the next five years?
I think you can draw a direct connect between that and power generation. And I think for that, the what you're likely to see is that the direct impact there would be more towards coal-generated power,
Mm-hmm.
or rather how the means of generating power. Now, that does not have a direct domino effect. I think what it could be, it could also be price equity for natural gas, to be honest, because a lot of people keep saying that it's the bridging fuel in the march to a low carbon or
Mm-hmm.
renewables future, nuclear future, however you might see. And of course, ironically, there some of the sunniest states in the US, like Hawaii, are generating their power from diesel. So of course you expect that to go, but then that's not a major demand center. So that has bigger implications for the coal industry, which are already for that matter more visible in Europe than they are in the States. But for sure, despite what Trump says, coal is on the decline in the States as well.
Another question coming from the audience is on the M&A side. We've seen an uptick in activity, right, with the recent bid on Anadarko. Do you expect more heated M&A activity on the oil side? Is there just fewer assets that are available? And is that driving consolidation?
Oh, absolutely. It harks back to the question about whether 15 million barrels per day is practicable by 2023. And I think it is, because a lot of big oil majors are now stepping into these shale plays. And we see the M&A, we see the consolidation. You're going to see more and more of it. So you had Chevron go for Anadarko, then Occidental, who was rumored to be the original bidders, has come in. There's likely to be more. We saw from BP last year that they'd made one of their biggest plays of $11 billion in the shale landscape by taking over assets from BHP. So there will be consolidation in the shale business. It's just that, will the big boys be as good as the independents in terms of tapping that resource? And let's not forget, each time I visit Houston, I keep hearing this, that a number of these private equity players are sitting with about $4 to $10 billion worth of dry powder. But they have learned their lessons from 2012, and they're not going to pay silly money for acreage and for distressed companies. They'll just bide their time. But there's a whole lot of M&A and consolidation coming in the shale space.
Thank you, Gaurav. I'm going to check with the audience if there's any other questions. I think that's it. So this concludes our webcast. Thank you so much for your time, Gaurav. It was really a pleasure. And we look forward to hearing you again on another topic around energy. Thank you so much.
Thank you.